Because if you're going to be a restaurant investor, you can't bail after a month, but you could in a stock. And the reality is that the majority of the people that are alive today and managing money weren't managing money through the 65 through 79. That was a different environment. And all right, now all the pieces in the puzzle are together. Now we're going to attack. Why wouldn't we do that in an investment portfolio?
Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Today, I'm interviewing Ted Hicks. Ted is a portfolio manager and wealth manager. He's the founder of Hicks Associates Wealth Management, based in North Carolina. Also the author of the book, Evidence-Based Investing, with a fantastic subtitle, To Invest Well Over a Long Term, Sometimes You Have to First Survive the Short Term. What better time than right now in January of 2026 to think about short-term survival versus long-term success. Please enjoy this interview with money manager and author, Ted Hicks. Super excited to be sitting down here virtually with Ted Hicks. Ted's the founder of Hicks Associates Wealth Management, based in North Carolina, and author of a fantastic book, Evidence-Based Investing, which I enjoyed reading and I hope we'll get into. Ted, welcome to the show. Good to chat with you.
I appreciate the invite, Dave. It's an honor to be with you.
No, it was awesome. You and I sat next to each other for a little while at the CMT Association event in Tampa a couple weeks ago, which was a lot of fun. Good to meet you. Good, and you gave a fantastic presentation. I was super excited to share some of those thoughts and insights with the audience. As a way of introducing it, right? Your book is called Evidence-Based Investing. And what I love about the subtitle is my favorite part, because the subtitle is To Invest Well Over a Long Term, Sometimes You Have to First Survive the Short Term. I feel like that phrase, what better time than January of 2026 to sort of understand and embrace that? What does that mean for you in terms of the short term versus the long term? How does that give you confidence to navigate what we can call a turbulent environment here in early 2026?
Well, I appreciate the kudos on the book. I am really humbled that the financial nerds like you and me are enjoying the book, but people like my wife who she would never read an investing book. And, and it's not just her, it's clients. I had a client come in a couple of weeks ago and he had read the book and he was like, I got it. So it seems like I was able to thread the needle relatively well in that regard. But the main point that I'm trying to get across in the book is just to try to dispel some of the myths that are just repeated ad nauseum in this industry. And we're all saving for the long term. We want to be long-term investors, but the reality is I use the example of a restaurant in my book, because if you're going to be a restaurant investor, you can't bail after a month, but you could in a stock. You could buy a stock and say, well, this is a bad decision and I'm going to get out. You can't do that. That's, to me, the fundamental difference between saving, and I use the term sophisticated saver in the book. So I believe that most people are in the middle. They're not a day trader, but they're not really a long-term investor. They're somewhere in the middle, and you have to have a process to navigate that, to calm their anxiety and to give them the confidence that, it doesn't mean I'm going to get every decision right. Yeah, we're going to take losses, but we have a process and we're going to stick through that because, Trump says such and such about Greenland or the tariff tantrum or President Biden. It doesn't matter who the geopolitical leader is who says whatever that causes a market meltdown. Is that a tantrum or is that the beginning of a downturn? And you're never going to we're not trying to get out at the top, but what I'm trying to communicate to our clients is that you have to have a process to navigate all of that. And, I think it's one of the Market Wizard books. I don't remember who said it, but one of the cliches was file the news. So I want to know loosely what's going on about Greenland. Do I care about the minutia? No, I don't. It's irrelevant, because if the stock market is going up, and I think we talked about this at the winter retreat, wasn't it 2023? You turn over into 2023, and we had the highest number of economists ever predicting a recession. And I'm like, yeah, no. Why? Because the market's going up. It's no. So
Right.
anyway, that's the concept, is we have to have a process to survive today so that you can live long term. And, that's the point.
That's one of the great misconceptions, and you and I, I'm sure, have found that often. And one of the speakers at the event made this point. I forget who it was, but we often flip between thinking that the economy and economic indicators are a great predictor of the stock market, and it's completely flipped, right? The stock market is one of the greatest predictors. It's a leading indicator for the economy. So I found following trends is much better
Right.
than trying to get ahead of economic data, right?
Yes. Well, I would take it a step further and say that
Yeah.
the majority of the reason why people look at the majority of the reason the majority of the people look at economic data is they're trying to discern what's likely to happen in the stock market or whatever. And I talk about Ben Graham in his book, in my book, and trying to do so as respectfully as I possibly can. But Ben Graham wrote that book in a different environment.
Sure.
And the reality is you don't have to put on a trade today and live with it for 6 months. So it doesn't mean we should ignore the economy, but we don't have to know for certain whether or not the economy is going to enter into a recession. And from a financial planning standpoint, the fundamentals, the principles don't change. You should make sure you have a solid cash reserve. You get laid off, you can live on your cash for 6 months or more, depending upon the other pieces of the puzzle, but it's irrelevant. You can also get laid off when there's not a recession. So
yeah,
it's like you said, it's the economic data is not a good predictor of what's going to happen in the stock market.
The
stock market is a good.
Yeah, hopefully, Ted, through the course of our conversation, we'll tease out some of the tools you use that you think give you a good sense. And I know in your book you articulate them very well. I was interested when I read that your father was a historian. That was something you mentioned in your book, and you have a number of great kind of historical references, right? Looking at the 1974 and the 70s, secular bear market, things like that. Can you talk a little bit about the value for you of using technical analysis as a history lesson? And maybe as a secondary question, when you look with a historical lens to what we're seeing today, what's that kind of analog or historical comparison that you think would best prepare us to think about this, this environment we're in?
That's a hard question. I believe you've heard the cliche, and I think I said this in the book. If you don't study history, you're doomed to repeat it.
Yeah, right.
Right.
Yep.
Right. If you don't understand, and the reality is that the majority of the people that are alive today and managing money weren't managing money through the 65 through 79. That was a different environment. Yeah. And it was Todd Petzel's book that made a comment that the United States stock market has been trading continuously for 200 years. And we're one of the few countries that can say that. And so the way that I talk to clients about this is like, I'm a baseball fan. If the Atlanta Braves make the World Series, that's it. Right. And so if I'm watching baseball and Dave Keller is coming to plate, it's the World Series. And the color man says, Dave Keller this season hit 355, but this postseason he's hitting 125. Well, some people will take that and they'll say, well, man, he's not doing very well. I'm taking that and say, Dave's about to get a hit because he's still a good hitter, right? He's just struggling lately. And so my point is, when you study that and you say that most countries have not had a stock market that has traded continuously for more than 200 years, I think we're somewhat delusional to think that maybe it could happen to us too. How do you navigate that? And I talk a little bit about this in the book, that I take my role as a shepherd of other people's wealth very seriously. People are hiring me and they're expecting me to know what to do. And in the dot-com crisis and the global financial crisis, I was doing everything, all the powers that be at the firm that I was with, I was doing everything they told us to do. It didn't work. And the the first time you go through the dot-com crisis, I graduated NC State in December 98. I started my practice with that particular firm in February 99. Of course, wow. 13 months later, we have the dot-com crisis starting. And somewhere in there, one of the leaders of the firm said, well, this is a once in a career crisis. It's good to get it over at the beginning of your career. It's like, that makes sense. It makes sense. So, we survived that barely. I get married somewhere along that line, and practice is starting to grow again, buy my wife a brand new minivan and a bigger house for the family. And then we have the GFC. Holy cow. But don't worry, Ted, this is a once in a career type of a crisis. I'm like, you guys said that already.
How many of those are we going to have, right?
Saying, how many 100-year floods are going to flood my basement? Right? And so the point of studying history is to see what has happened and what can we learn from that so that we can anticipate how we would navigate a similar type of a crisis. Yeah. That's why I study history. And then from probably some of the posts that you're talking about in LinkedIn, I try to use, especially the military historical lessons. Over my shoulder is the signing at Appomattox. That's Grant and Lee, the surrender in the Civil War. That piece used to hang over my dad's desk. And so I try to weave that in and just try to use the example. General Grant was arguably the best general ever. But was he always on offense? No. Did he win every battle? No. Sometimes he was tactically retreating. Sometimes he was just fortifying positions, waiting for Sheridan or somebody else to come and support him. And all right, now all the pieces in the puzzle are together. Now we're going to attack. Why wouldn't we do that in an investment portfolio? It's not, you don't have to put together a portfolio and then leave it the heck alone. It doesn't make any sense. But as respectfully as I can, I try to talk about this in the book, that the vast majority of the people that manage money for the retail John and Jane Q public, they're not trained to manage money. Yeah. They're licensed, don't get me wrong, but they're not trained to actually manage money. They're trained in sales. A lot of them are, myself included, we hold ourselves out to be comprehensive financial planners. And with the CFP board of standards says that there's 6 key areas of financial planning, right? There's your current situation, your protection planning, investment planning, tax planning, estate planning, and retirement planning. Those are your 6 key areas. One of those 6 key areas is investment planning. And so I say that there are 6 key areas of financial planning, but they are not equally weighted.
Yeah.
And if you do everything right, and then you try to retire right at the beginning of the global financial crisis, and you have no defensive strategy, you are what we refer to as being up the creek without a paddle. Right?
It is an interesting point, and I think you're right. I mean, I think there are probably hundreds of thousands of advisors in the U.S. at this point. Would be my guess. I don't really know the number. That's probably about right. And I wonder how many of them, and I would argue not enough, think about market dynamics and how that should inform our conversations with clients as much as you and other CMT charter holders that are that are in your line of work. I think is a much more effective way to think about it, for sure. One of the great quotes in your book, as I was reviewing it, Ted, was diversification finds you right when you need it the most. Is that right?
Fails you.
Fails you. Diversification fails you right when you need it the most. Thanks for that. So can you tell me, that makes a ton of sense to me. How does that resonate in terms of how you try to structure portfolios? Because diversification is one of those kind of generally accepted principles of money management. Why does that fail us, and what do we do differently?
Well, this is the reason why I spent so much time on the book. And again, I mean, you've read the book. The book it's very thin. It's an easy read, right? But I spent a fair amount of time at the beginning of the book trying to talk about Markowitz and the modern portfolio theory and the efficient frontier and things of that nature, because that shapes so many of the talking points from Wall Street, like diversification, like being invested for the long haul. and things of that nature. And we hear it all the time. And I think somebody at the CMT symposium even said it. Wealth is created through concentration. It's preserved through diversification. That's hogwash. No, it's not. Now, has wealth been preserved through diversification? Yes, that has worked, but it is not guaranteed to work. And 2022 is a classic, easy example where just about everything is going south.
Yeah.
So how did diversification work for you that year? Not very well, right? And so Markowitz's theory, which is truly groundbreaking, right, Dave? I mean, it gives the guy credit. It was a fantastic paper, but I really don't believe he had any idea that he was writing something that was shape finance for the next 50 years or more, right? And, you know, the point is there's so much math in that book. I actually have it. It's on the shelf behind me because I started writing my white paper in my book. That's how all this got started. And I started writing something like, well, most retail financial advisors have never actually read. Wait a minute. Neither have I. So I bought Markowitz's book before I wrote my book, and I went through it, and it was very interesting. But the point is, most people they know the Cliff Notes version. Yeah. They know the talking points of what the conclusions are, but you need to know what the assumptions are, because the assumptions are not slightly wrong. They're dead wrong. And so the concept of diversification, it makes sense because correlations are different at a point in time. And that's how he got the math to work. Yep. But again, 2022, correlation goes to 1. Everything is going down. So diversification fails you right when you actually need it. And so the flip side of that argument is, well, does it serve any purpose? Now, don't get me wrong. I'm not saying that you shouldn't be diversified. We are diversified, but we diversify 2 different ways. We diversify with strategies, right? And then we also diversify with the position. So we're not like metals and mining are doing fantastic, right? And again, one of the Market Wizard books, one of the quotes from one of the guys was, there's only 2 position sizes, too much or too little. So that's right a good now, one. Yeah, we have metals and mining, not enough. I wish we had more. Yeah. Right? Why? Because they're working. So we have other positions, and we are quote unquote diversified, but we don't care if we don't have a particular, like international. I don't have a true international ETF. One of our tactical strategies is ETF focused. So think of VEA as the Vanguard International or Developed Markets ETF. Yep. We're not holding that right now. Why? Because it didn't do what we wanted it to do, but we are holding, at the moment, we're holding 2 single country ETFs, and we just recently sold a 3rd one. So we have international exposure, but we don't have it because we want international exposure. That is irrelevant. Nobody cares. Right. So it's less about diversification for diversification's sake. It's more about diversifying into compelling ideas as they emerge. Is that a fair way of describing it? I would argue it's being agnostic as to what we're buying, right? There we go. So, assuming it's not illegal or immoral, I don't care what we buy, right? Because I use this, I say this all the time to clients. Usually when a client gets a statement, they look at the starting balance and the ending balance. Hey, honey, what's for dinner? That's it. That's their analysis. Yeah. Don't get me wrong. Every once in a while, we do have a client that actually looks in the weeds and they actually are looking at the trades, and that's rare. Most clients just don't care. And I've never had a client come in and say, you know, in a down market, well, at least we're diversified. If it doesn't help, why are we doing it? So again, don't mishear me. We are diversified, but the way that we are diversified is we're not using diversification as a clutch or a crutch rather, and thinking that's going to save us in a down market.
Yeah. Yeah. Yeah, no, that's really well put, and really well put. And I think, Ted, that's the issue, is a lot of people assume that diversification on its own is a great risk management strategy. And unfortunately, 2022, classic example of where correlations went to one. It didn't help much at all. Ted,
Yeah.
we've lasted about almost 20 minutes before I brought up aviation, and I'm pretty proud of myself for being patient about that, because that's something you and I both have a passion for. And in fact, one of the indicators that you talk about in your book, you call the VSI, which I think is a reference to vertical speed indicator, which is one of the dials you watch in an airplane. I'm curious what your experience is in aviation. Have you found any relationship between your experiences trying to stay in the air and trying to be a good pilot and trying to be a good investor?
Well, you gave a great presentation at the CMT Winter Retreat too, and you talked about checklists. Yeah, you have checklists.
Yeah.
And I use that. I talked a little bit about that in the book. You pull out the checklist. Now, I'll give you a story. Shortly after getting my private pilot, maybe, I don't know, 6 months, I was flying. I flew my longtime practice manager and her daughter to Wilmington, North Carolina, which is about an 1.5-hour flight.
Okay.
And on the way back, you and I both know what a sterile cockpit is. So to the listeners out there, when a pilot in a small airplane says they're looking for a sterile cockpit, that's a polite way to say, shut up, I'm trying to concentrate. Right. And so the point is, we're coming in to Raleigh and we're hitting some pockets of air, and it got turbulent on the way down. I got a sterile cockpit real quick because all three of us were a little scared, right? Well, what do you do in that scenario? Well, I don't know what your CFI told you, but mine is to fly the airplane.
Right.
You can't think about all of that other stuff. Stay ahead of the airplane, which to me is very key, right? Staying ahead of the airplane is anticipating what's the next thing that I'm going to need to do. So if you're in a position, staying ahead of the position would be, well, where do I want to exit this? One of the cliches that you hear in this business all the time is buy low and sell high. You know that only works, Dave, if you actually sell high. So where are you going to exit? What are those conditions? So you stay ahead of the position, and you just shut out the noise. Now, don't get me wrong. My practice manager and her daughter, I'm 100% confident they were a little nervous because they know their boss and, flying 6 months with the license, right? I was nervous. I can't worry about that. You just got to fly the airplane. And that's the same thing. When we're looking at individual positions, we manage each position individually in our tactical models. Our quant models will let the rules dictate. But in our tactical models, yesterday was a good example. Everything is selling off yesterday, right? No. So I'm not worried about it. The metals and mining did fantastic yesterday.
That's right.
Yeah, too small of a position size, because it'd be nice if the whole thing was in there right now. But, it's joking aside, fly the airplane. What's your checklist? Follow your process, and, leave the results to God. That's
well said. I know my CFI would often say, aviate, navigate, communicate, right? Fly the airplane first, then figure out where you're at. And then the last one is communicate. And a lot of people get into trouble, start communicating first and forget you got to keep the plane in the air, most importantly, right? So I think that's good guidance. The VSI indicator that you talk about in your book, to pivot just into your use of technical analysis, Ted, it's what I would describe as sort of a composite indicator, is how it sounds like, right? Where you're taking a number of different indicators, kind of combining them into one master indicator. Can you talk about kind of what that looks like? You don't have to get into the secret sauce of it, but just what does that do for you in terms of simplifying your analysis, and how do you sort of use that to think about the opportunity set that you're faced with?
So one of the best things that it does for us is it helps us communicate with clients.
Okay.
When I show them a monthly candle chart over, say, from before the .com crisis, so say 1998 through 2009, and I show them a monthly candle chart and it's color coded with my VSI. And I say, well, just theoretically, what if we only invested in the green candles? How do you think we would do? I mean, you don't need to see the math. I do have the back test, but it's a very easy way for us to say this. It's just a stoplight. That's all it is. It's just taking the weight of the evidence, and it's not a perfect signal. I go through that with clients all the time, and it's not the tool. It's a tool. It's one of the many things. It's just the easiest thing for us to explain to clients, and they get it. And they talk about it a lot. Again, it's not everything, but it's also a filter. So it can drive a quant model, but it's also a filter to help us determine, well, we're on a red light here, where the VSI is flashing warning signs. Do we really want to open up a trade right now? Right. And sometimes we will, and sometimes we won't, but it's designed to helps us to be dispassionate.
I like that. I often talk to people. I mean, it's so fun. And to be totally honest with you, Ted, your book feels like the book I wish I would have written. And we think in such a similar way, which is what I've learned from talking to you for about 30 seconds. I'm like, yeah, we are like-minded. I always talk to people about getting away from an emotion-based investment process to an evidence-based emotion process, right? And that's something pilots do remarkably well, right? Make decisions on the evidence and not based on the panic of what's happening in the airplane. And I wish more investors did that. I really love how you describe how it helps you communicate with clients, because I have found the same. I found with a lot of advisors, there's a visual element to understanding the markets with charts that I think resonates with a lot of people. I wish more took advantage of that in terms of how you describe it. Just to finish off, Ted, we have to talk about the current market environment. I mean, you mentioned the choppy session we had on Monday, or on Tuesday. This is coming out of the holiday weekend here in the U.S. and a lot of news flow over the weekend, events in Davos this week. And so the market's been pretty choppy so far. As you start off in 2026, are you generally, I mean, you don't know what all you can say, but are you positioned, or is your expectation more of the same in terms of the strength we saw in 2025? Do you find yourself more measured about your outlook given anything that you've seen? And what are some of the key, elements or key charts that you're following here today?
Commodities and energy would be certainly some charts that have my attention. Yeah. But I would tell you, Dave, that if you ask me, I will give you my, I don't even like to say outlook. I don't even like that term. But this is what I think is going to happen. But I need you to know, Mr. Client, it is 100% irrelevant.
I love that disclaimer right up front. Yeah.
It doesn't matter. Right. Yeah. So for example, you've been around this industry long enough. We know the presidential cycle. I mean, so the second year of a presidential term typically does this. It's irrelevant. Yeah. One thing that I'm curious to ask you about is last year, one of my habits is, so I have a YouTube channel that I put up mainly to communicate to clients. It's not really a client acquisition thing. It's mainly to communicate current thoughts to clients on the markets, because I'll meet with a client today and I'll pontificate or whatever, but I'll change that opinion tomorrow. So that's the purpose of the YouTube channel. But I don't like putting outlooks out there simply because I'm very comfortable changing my mind and changing the answer. So that said, one of the things that I was doing a lot last year is looking at the seasonality charts. And I didn't go back and study that, but as I'm looking at the seasonality charts later in the year, I'm like, why am I talking about this? It seems like the seasonality charts have just not done anything positive. Yeah. Now, again, it's irrelevant for how we actually trade and what we actually do. Just information. This month is historically good. This month is historically bad, except this month was actually really good. I mean, so how much of that second year of a presidential term, I'll tell you, Mr. Client, this is what it says, but it's irrelevant. Our quant model on buy signals, they've been on buy signals for quite a while, months. I mean, since April or May or whatever that was, probably May. And our tactical models raise cash as appropriate. And so as it turns out, yesterday, our stock model was already 80% in cash, and our tactical ETF model was 20% in cash. And if you don't understand how that works, it doesn't mean we're 100% in cash. It's two different models, but it's not predictive. We're not saying there's trouble ahead, therefore let's raise cash. It's like, no, this particular position, this particular ETF trade is up 27% in a month and a half.
Yeah.
Maybe we should ring that bell.
Yeah.
And so we'll raise cash because, again, at the moment, like 70% of the assets that we manage is qualified money. So
okay.
it doesn't matter, But as far as what I'm looking at, commodities, energy is having a fantastic day.
Yeah. Yep.
Right. I'm not in energy. I mentioned we have several mining and critical materials types of position right now. I'm a little concerned about that because my understanding of intermarket analysis is that those are late cycle leaders.
Yeah.
Right. So does that mean no, it doesn't mean anything. It just means we're going to stay alert. We're aware, but what are your thoughts?
No, those are all really good points, Ted. To your comment about seasonality, I would agree. And talking to like Jeff Hirsch, who edits the Stock Traders Almanac, right? He would tell you that those seasonal tendencies, they're tendencies, right? They're not rules, they're not absolutes, they're tendencies. So this is what tends to happen. And it's, what happens, these are general tendencies. So this is sort of the base case, but there are one-off events that are going to happen that could cause the market to stray from that kind of traditional cycle. So he would describe it as this is what, barring some other big thing happening, this is what's most likely to happen. But I feel like we're in an era where those big one-off things seem to be happening at least once a week at this pace. So seasonality was not particularly helpful in 2025, I would say, because the market didn't follow the seasonal pattern. There really wasn't the drawdowns when you'd expect. And then, the market was much stronger than you'd expect in a lot of times. But for me, it was a masterclass in why following trends and just having a disciplined process of recognizing changes of character, that was the game, right? It wasn't about knowing what was going to happen ahead of time. It was just recognizing when things were changing. And I would say there's a big shift from Q3 of last year to Q4 of last year, going from kind of growth over everything to a bunch of other things starting to work. And now, I think to your point, we saw metals and mining really starting to work, second half of last year. Now we're seeing energy come in a way we haven't seen in quite some time. If there's anything that concerns me, I think you alluded to it. It's the fact that those are the things that tend to work kind of toward the end of the cycle, not the beginning of the cycle. But if we follow the charts effectively, right, we should have a pretty good sense of when the cycle is changing and when things are shifting and when defensive sectors start working. We're not seeing a ton of that yet, but that would be the thing I would be looking for next.
Right.
Yeah. Really, Ted, listen, really, really good summary of things. And if nothing else, I hope people take out of this conversation. Number one, I think your book is excellent. I enjoyed reading it, and I would encourage people to check it out. We'll definitely include a link so people can review it. Again, I'm super jealous that you articulated so many things that are important to me and other like-minded technical analysts out there. So thanks for putting that to print and getting that out there. Thanks for summarizing how you use technical analysis, particularly in how it enriches your conversation with clients. I think that's a message that I hope a lot of advisors take away. And finally, I hope this is not the last conversation we have together, Ted, and I'll look forward to having you back on the show down the road.
Anytime, Dave. Anytime. I
Thanks so much.
the invite.
It was a fun conversation. Thanks again to Ted Hicks joining us from North Carolina today. As I mentioned in the interview, I sat next to Ted and we'd connected randomly over social media, but I sat next to him for part of the CMT Association's midwinter retreat recently in Tampa. Just immediately hit it off. He's a genuinely wonderful human being, as you could probably tell from the interview, just a great sense of humor and very personable. But besides being a nice guy, he also is an incredibly thoughtful and knowledgeable investor. And that's where I really appreciated his perspective. I picked up his book and really enjoyed digging into it in a lot of ways. Really mirrors a lot of what we talk about on my market recap show and in my work with our Market Misbehavior premium members. Thinking about technical analysis as a history lesson, right? Using charts to think about what has happened previously. Not that that's a perfect playbook for what's going to happen, but at least it gives you some framework with which to try to make sense of a market that seems unpredictable in so many ways because of all the sort of new information we're getting every single trading day. Thinking about diversification for diversification's sake, this is a theme that's come up with a number of my interviews for the podcast, where people, certainly recognize the superior approach to focusing on momentum, focusing on trends to diversify, but let's diversify across things that actually look attractive and not just diversify and intentionally get into things that are not particularly strong. That conversation about what he calls the VSI, the vertical speed indicator, for stocks, and as I described as a composite indicator. This is a common technique, not something that I use in my own work, but a number of people, not just Ted, but others that I've worked with over the years that have kind of developed their own composite indicator, a way of summarizing market activity, and instead of looking at a ton of different indicators, you kind of boil them all down to one particular thing. I think there's a lot of value in that because in a lot of ways, technical analysis isn't just about analyzing the markets. It's also about having a common language, a common way that we can describe market action to each other and, have more consistent returns by having a more robust process. And I would say in a lot of ways that idea of a composite indicator makes a ton of sense. Totally agree with Ted's take on the broad market environment. We are on the same page in terms of the rotation, in terms of where we're seeing opportunities. And again, just the benefits of consistent processes to continue to identify great potential charts. And always a pleasure to speak to a pilot who has experience in the air and experience in the markets, because I have found over the years so many great parallels between those things. And I think Ted, who's had great aviation experience, far more than I have, more hours and more cool planes, but really brought some great insights there as well. Thanks again to Ted Hicks joining us on the show. Again, I'd encourage you to check out Evidence-Based Investing. We'll include a link to that book. I enjoyed it very much. An easy read, but with some great points. Also some really interesting points at the end about faith and how that relates to everything else in the book, which I hope you enjoy as well. By the way, if you want to learn more about technical analysis, behavioral finance tools, how you can develop more consistent processes and routines in your own investing, our Market Misbehavior premium memberships were designed for just that thing. 3 great benefits to the premium membership. First off, you can access all of our virtual courses where we'll teach you about behavioral finance, technical analysis, and how to develop good routines. Second, you'll have access to all of my members-only reports like our monthly chart review, our weekly flight plan, our 2026 market outlook, which was released just a week ago, and benefit from all of those things. Really showing you, my goal there is to show you, to demonstrate how we can use those routines that you learned about in a real-time situation every trading day, every week, every month. Finally, you have full immediate access to our member community where you can ask questions, where you can learn from others, and you can help and support a group of like-minded individuals trying to get good returns and manage risk using technical analysis. If all that sounds interesting, check it out at marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for this episode. Thanks so much for joining me here on the Market Misbehavior podcast. My name is Dave Keller, reminding you, as always, it's always a good time to own good charts.